Okay, welcome everyone. We're pleased to invite you today to our presentation on managing transfer pricing during COVID-19. Transfer Pricing Solutions will be running a number of webinars over the next few months whilst most of us are sitting in isolation, but being able to keep you up to date with some of your transfer pricing matters that are coming up. So a bit about, for those that haven't been involved with Transfer Pricing Solutions before, we are a boutique specialist transfer pricing firm. We've really focused on providing a practical, proactive and cost-effective advice, transfer pricing advice in Asia and also around the world. We have a global list of clients. We've got more than 10 years experience and a very flexible team. So we certainly can help you with all of your transfer pricing matters. On our the Transfer Pricing Solutions Group, we are based in Australia. That's our founding country. We've also got an office in Singapore as well. We opened up in Singapore a number of years ago and we've become quite a leading firm in Singapore in transfer pricing. And more recently, in the past 12 months, we opened up in Malaysia. There's been quite a bit of interest and demand for that as well. So we can certainly help you in all of those three countries and on a global basis. So my name's Shannon Smith. I'll be the moderator today. I'll be managing the webinar questions and also overseeing the running of the webinar. For those of you who are not familiar with using Zoom before, if you just look, actually, you'll see some of this space on your screens. You can do the chat, but what we do have a bit of a preference, if you could just click on the Q&A, any questions that you have, click on the Q&A and we'll get through to those questions towards the end and we can give you some feedback and comments on those. So I'm very pleased to introduce to you all our presenter today, Adriana Calderon. She's our Director of Singapore and Malaysia in the Transfer Pricing Solutions Group and is based in Singapore. Adriana has many years of experience and is actually considered one of the leading advisors on transfer pricing in Singapore. So I'll hand it over to you, Adriana.
Thank you, Shannon, for such a great introduction. And thank you for inviting us all today to talk about transfer pricing management during COVID-19. So I want to start this discussion with setting up the scene and talking a little bit about the purpose of this webinar. So I would like to first draw your attention to this funny fact, but that is true actually, which is about how we measured profitability in different countries and companies. So before, we always talked about earnings before interest, tax, depreciation, and amortization. And now we have a new big factor coming into place that can affect profitability, which is the coronavirus. So the question is, and the purpose and the goal of this webinar is, how does COVID-19 or coronavirus affects company profitability and EBIT, and will affect the profit that is allocated in each country? So what we thought we put together today is some sets of strategies that can help you on how you can manage the effect of COVID-19 in your different countries. So we have come up with 5 different strategies, which we will talk about it today. Strategy number 1 is how to quantify the economic impact of COVID-19. Strategy number 2 will be about when is a good time to perform searches for 2020 TP documentation. Strategy number 3 will be about how to manage losses and routine entities, which is a big hot topic at the moment. Strategy number 4, what is the impact of changes in the supply chain due to COVID-19? And strategy number 5, what to do if a related party entity cannot pay interest rates in an intercompany loan. So let's start with strategy number 1. So I think this is a big question for any CFOs, finance managers, and tax managers. How do we quantify the economic impact of COVID-19? So we have some examples of measures that can help with the quantification of impact of COVID-19. Why is it important to quantify? Because the economic impact will impact your profit, and to show the tax authority how it impacts your profit is important to quantify, to measure this economic effect. So the first measure is quantify the decrease in demand. The decrease in demand can be measured by comparing your actual sales versus budgeted sales, showing the decrease from the moment that COVID hit the demand in your industry. This type of analysis shows the importance of having a budget in place that you can use within your company to show any deviation from the budget on sales. The second factor that can be used to quantify the economic impact of COVID-19 is the increase on operating expenses due to COVID-19. It will be critical to identify which operating expenses or any new abnormal expenses that can impact your profit. For example, bad debts write-off. We all know that there is a lot of companies that may not be in a position to pay or may be struggling with cash flow. So that might impact the possibility of some providers to receive payment and as a result may have to write off certain debts. Increase of marketing expenses. As we all know, we may all want to try and increase or change the way in which we market in a virtual world. That might increase your marketing expense. Say, for example, that before you were relying on referrals and now you decide to run a campaign on Google Ads. That will increase your marketing expense and budget. That will need to be quantified to see whether it impacts your profitability. Increase on freight and logistic costs, and also any retrenchment fees. They can give the basis to adjustments on expenses that could be adjusted when calculating profits. Say, for example, you will need to understand whether some of these operating expenses are considered abnormal and maybe there is basis to exclude them from any calculation of profit, or in the contrary, they are just operating expenses that need to be maintained and the adjustment needs to be made on the comparable data, which we will talk about more in strategy number 2. The factor number 3 will be a comparison of budget profit versus actual profit. This is a similar analysis to the one that I have discussed in point number 1, which is basically what is the deviation of actual profits versus your budgeted profit to show the impact of COVID and show whether if it wasn't because of COVID, meaning pre-COVID world, you would have achieved your budgeted profit. And it's just due to the fact that COVID came in that your profit went down or dropped. The fourth factor is whether there are any excessive foreign exchange gain or losses that impact your operating expenses and at the end, your profitability. And it is worth assessing whether abnormal foreign exchange losses could be considered, again, abnormal expenses that can be taken out and adjusted for when calculating the operating profit. So I think with strategy number 1, the key thing that we need to consider is on expenses side, whether there is merits to adjust those expenses and recategorize as abnormal to take them out of the equation of the calculation of operating profit that we will be used for the purpose of doing the benchmarking and the analysis search, which we will talk about in strategy number 2.
Now, I do have a question that's come through, Adriana. I wanted to ask it now. Someone's popped up a question. Can COVID-19 expenses be considered abnormal due to being one-off?
I think that's a great question, Shannon. I think we have to come back to basics, and is what does the OECD and the tax authorities understand for abnormal? And I think we have to make a really good case to explain that abnormal is expenses that are one-off, that are not recurrent. If we say that the expense is something that is recurrent, but it's just that increase, like the operating, like the marketing expenses, I think it will be very difficult to explain that is abnormal. But in the other hand, if it is a retrenchment fee, or if it is a one-off expense of freight that was increased only for a certain period of time, while COVID-19 was restrictions were lifted, I think it's easier to explain as to why it's abnormal and do the adjustment. The same with the foreign exchange losses. If we can say that there was a drop, for example, in Australia, the Australian dollar has crashed significantly. If there is a ramp up of the Australian dollar in the second half of 2020, and we can quantify the period in which the Australian dollar crashed, and it was just for a certain period of time of 2020, and it was just an abnormal difference, there will be some basis in that argument to say that can be adjusted and taken out of your operating expenses that impact your operating profit. I hope that answers the question. If not, I'm happy to clarify at the end.
Yeah. So if you do have any further questions on that, just send them through as we go through.
Yes, please. So let's talk about strategy number 2. Strategy number 2 is one that is a very important one and is very close to my heart because I love anything to do with benchmarking. So it's about thinking more on planning mode rather than reactive, or what I call reactive TP, which is when the transaction already happened. And I think what we need to understand here is when is a good time to perform searches for 2020 TP documentation. So this is critical. And maybe for some of you who have not performed TP documentation before, or have not performed searches, I don't know, maybe you are aware, maybe you're not aware of one critical issue, and is when is data for 2020 available for analysis? See, in practice, data for a particular financial year end, say for example, 31st of December 2020, will only be available 6 months after the year end, meaning not earlier than June 2021. And this is not considering the fact that a lot of governments have extended filing dates due to COVID-19. For example, in Malaysia, the usual filing date is around June, but the Companies Commission of Malaysia and the authority in Malaysia have extended this deadline to September 2020. If that's the case, we can potentially see an issue around finding comparable data for Malaysia in 2021, and I will say not earlier than June, probably June or September next year. I think a couple of options that we have thought about after talking with some of the clients who have asked us about this issue, and is how do you deal with this? What are my options available to deal with and manage this issue of the late data available? Option number 1 is using 2019 financial data, but for the taxpayer, meaning your tested party or the company that is using this data, you may be forced to do a multiple year analysis. What that means is that usually a TP conclusion is drawn based on a single year or on the single year that is being tested. If I'm testing 31st December 2020, I will be doing an analysis for 31st December 2020 year end against 2020 or 2019 financial data of the comparable companies. But if you only have 2019, that means that the comparable set will have overestimated profits because it doesn't consider the effect of COVID-19. If that's the case, the taxpayer may be better off with analyzing the results over a various or a multiple year, which could be 3-year or 5-year. What that means is that the taxpayer can analyze their 2020 in combination with 19 and 18, if you're doing a 3-year analysis, or if you're doing a 5-year analysis with 20, 18, 17, 16, and 15. And explain that on average, for the 3-year or the 5-year, the company was still within the ranges. It's just that 2020 was impacted by COVID-19. That is one option. So key of option number 1 is resort to multiple year analysis if you're using 2019 financial data. Option number 2 is, if using 2019 financial data, consider adjusting either the comparable data or the taxpayer to count for the impact of 2019. Option number 2 has a bit of a challenge, and is how to do reliable adjustments, especially on the comparable data, if you don't have a lot of detail on the comparable data about how to quantify or hypothesize the COVID-19 impact. Option number 3 is, if using 2020 financial data, if you can afford to wait until 2020 financial data is available, you will hope that by doing a robust and thorough benchmarking search with industry focus, you can really show the impact of COVID-19 in the comparable search, assuming that it is very robust in terms of industry. Now, if you ask my opinion about which of the 3 options I will prefer, or I will think is more practical to implement, I will say that option 1 and option 3, because it requires less adjustments. Option 2 can be difficult to adjust in such a way that the tax authority will accept those adjustments as objective, but I thought I will share it with you in case there is a way, in a case-by-case basis, to do this adjustment. And my last point on this slide is that it's important to reassess also whether safe harbor prices allowed by tax authorities are still reliable. So some countries like Australia, Malaysia, Singapore, and other countries in the region, I believe Malaysia doesn't have safe harbor prices, will have safe harbor prices like acceptable fixed markups or acceptable safe harbor interest rates. Therefore, the taxpayer will need to review whether those safe harbor prices make sense for 2020 and whether the company will be able to meet these safe harbor prices. I would like to invite my colleagues, Shannon and Hon Chuan Tan, to provide a view on what will be the best way to handle or manage the data in Australia and Malaysia to perform searches for 2020 TP documentation. So Shannon.
Yeah, so if I touch on a bit about Australia, so the data we're going to be looking at, depending on what year end you're comparing it to. So in Australia, we do have our tax year end, generally speaking, in Australia is 30th of June. However, many companies that are foreign owned will actually change their year end in Australia to align that with the parent company, which might be 31 December, 31 March, depending on which country you're in. And the tax return lodgement due date is 6 months and 2 weeks after the year end. So if you are a December year end, your lodgement won't be due until mid-July. And so what that means from a data perspective and looking at it in the benchmarking, in undertaking a benchmarking, we need to, I guess, establish what year end you are. And then if it is data for example, June 20, we would probably not be looking at doing the undertaking the benchmarking till just after December of the following, of the end of December 20, on the basis that we may not have all of that information readily available at this point. So it will be very much dependent on when your year end is. HC, would you like to make some comments on Malaysia for us?
Yep. For Malaysia, majority of the companies will have a year end of December 2020. Based on our experience in Malaysia, data available at the Companies Commission will generally be delayed, and you only be able to access those data by June to August next year. So theoretically speaking, what we generally recommend people do is to, of course, as Adriana have mentioned earlier, option 1, to do a multiple year analysis. But all these will be dependent on case by case basis. If you look at different industries, certain industry will be majorly impacted more by the COVID-19 than others. So option 2, for example, doing a comparable data analysis will be very subjective on the tested parties' financials as to what operating expenses has been affected, and then on case-by-case basis to look at the comparable data and assess the comparability adjustments on those comparable companies. Option 3 will generally be the more relevant one when we have access to the 2020 financial data that would showcase the actual impact of COVID-19. So generally we'll go for option 1 and then properly document down what's the impact on an economic analysis basis, and then wait for option 3, then finally to test the arm's length return on your tested party.
Yeah, fair enough. I think actually in Singapore is probably the one country where we can wait a bit more, mainly because the lodgement of the tax return is 30th of November of the following year. So if you have 31st December 2020 year end, which is the majority, you will have until September 2021, November 2021 to lodge the tax return and have the TP documentation ready. So it seems to me that in Singapore is the one that we have the better chances to go with option 3 and wait, as opposed to Malaysia and Australia, where you have to lodge your tax return a bit earlier. All right, Shannon, any questions from the audience so far?
No questions on this one, so I'll get...
Okay, all good. So let's go to strategy number 3. Strategy number 3 is, I think, another one that has been discussed extensively together with many TP practitioners, because it comes down to core question, even without COVID-19, is who bear the losses in the group. So strategy 3 is how to manage losses and routine entities. So this is a tricky question because a lot of the times it depends on the view of each tax authority on whether low risk entities should bear part of the group losses, or in the contrary, low risk entities are basically entities that should have a guaranteed profit. So in my opinion, there are 3 key factors to address. Factor number 1, which is, I will say, TP one-on-one, determine which entity in the group should be bearing the losses based on characterization and contracts. Should be borne by the entrepreneurs, or in the contrary, should be borne between entrepreneurs and routine entities, assuming that the routine entities also bear some level of market risk. And also a key point is how the contracts have been drafted. if there is contracts between the entrepreneurs and the routine entities, I have seen lately, especially a trend towards contracts that give a guaranteed profit to routine distributors. If that's the way in which your contract has been drafted, it will be even more difficult to argue the why that entity should bear a level of losses. So the third point is, or the third factor is low-risk entities such as routine service providers without guarantee markup or routine distributors with guarantee, whether your entity that you're testing is a low-risk entity without guarantee markup or a guarantee profit. In this situation, as I was saying earlier, it will be a lot harder to argue that that entity has to bear the losses. And you will have to consider the tax authority of the country of that entity or low-risk entity, whether their view is that they will accept low-risk or routine entities bearing losses, and also look at some of the comments and guidance in the OECD and and more importantly, the local TP guidelines views. My biggest worry in low-risk with low-risk entities, especially in Asia, is that different to some Australian, and Shannon will talk about Australia once I finish these three key factors, is that a lot of the TP guidelines locally have been drafted in such a way that if you have a low-risk entity and you're doing a benchmarking, you shouldn't be including loss makers in your benchmarking, which make it impossible to support any losses for routine entities, which will show you also a good indication that the tax authority view is that low-risk entities should not be bearing losses. Having said that, we are actively now communicating with tax authority in Australia, in Singapore, and Malaysia to get some level of comfort on what is their views on this point, so we can advise our clients accordingly.
Adriana, we've had some questions come through that might be relevant to that one.
Yes.
So I've got a question here from Betty. Will the COVID-19 impact the agreements that are signed between related parties, for example, on the volume and price that are predetermined between certain companies? Also, should companies relook at their existing agreements and draft new ones?
I think that's a very good question, because I will see in two steps that question. First is, okay, if you already have agreements, as I was saying earlier, that guarantee, the ones that I have seen the most common is you guarantee a fixed markup, let's say 10%, or you guarantee to the distributor an EBIT of 3%. Then the company will have to first look, coming back to strategy number one, if your budgeted profit versus actual profit is going to drop, and then you're going to have an issue with complying with the contract. If that's the case, then I think the group has to make a decision whether they need to amend the contract to address that the old price that was agreed is not suitable anymore, and do an amendment to it to say we're not gonna reach the target EBIT or the target markup, and therefore the contract needs to be amended to a different EBIT target or to a different markup. The same goes with volumes and with, what was the other point, Shannon? Volumes and?
Volumes, volume and price on predetermined between certain companies. Okay,
so I addressed the price. Then the same goes with volumes. If basically the entrepreneur or whoever we're supplying to foreseen already that they don't need the demand that, or they don't need the level of products that they forecasted that they needed, they will have to amend the contracts accordingly. and then assess, obviously, if after post-COVID, they don't need to do any changes in the contract, or they have to restate the contracts as if they were before COVID or not. I think a third factor here is, obviously all of these make sense and decline on profit or losses make sense, as long as you have a robust argument around the impact in your industry. Because as we know, some industries will be more impacted for COVID versus other industries. So for example, traditional retailers, we all know that they are suffering, right, at the moment, and are being forced to move to e-commerce. So if you're a traditional retailer, you might have a strong case for showing the impact of industry. Versus Zoom. We all have seen the news on Zoom having abnormal demand for subscriptions. So a company like Zoom will struggle to say, well, we have been impacted by COVID, given that they have an abnormal demand of subscriptions due to remote working solutions. I think my key tip here for anyone who is trying to find a robust argument on impact in industry is to keep an eye on the information that is being released now. You all have probably seen the amount of information about industry impact of COVID. Almost every second argument, every second article you see in LinkedIn or in all social media is about impact of COVID, impact of COVID. Create a little file in your desktop to save anything that is related to your industry. And that way you have enough tools to set up your the impact in your industry due to COVID-19. And that is even what we will do as a practice in our firm. If we have clients in a particular industry and we see industry analysis related to COVID-19, for sure in our team, we will be saving this industry analysis to be able to build up the story for our clients if they have genuinely been impacted by COVID-19. So Shannon and Hon-Chan Tan, I would like to hear your views on the management of losses for both routine entities and low-risk entities in your particular countries. So Shannon, I'll hand it over to you first.
Please. Yes, I think similar, you've touched on a lot of the points that I think will be relevant with Australia. Especially, I guess Australia will take a bit more of a practical approach. And as you mentioned that, you know, normally we do exclude loss-making companies out of our benchmarking when we are going through that process. But what we've learned from the GFC back in 2008 is that loss-making companies may very well be comparable in the industry in which you're operating in if you are being impacted by these situations. So I think that it is going to be something that we need to support, as you mentioned, having that file there and having that commercial story to be able to justify why, in fact, that you've actually potentially gone to a loss situation, maybe against budgets as well, and whether there does need to be any pricing. Again, it will come back to your agreement, but ultimately a no-risk distributor is going to have a potential for a permanent establishment in Australia, which we obviously want to avoid of the parent entity. So it is going to be a situation that you do need to have a look at your agreement. Most likely a lot of your agreements won't be tying it down to an absolute margin, and there will be, a risk on that limited risk distributor or distributor here in Australia that they may in fact make a loss if the whole market does go down and they don't have enough dollars to basically cover the fixed costs. So I'll pass it on to HC.
Thanks, Shannon. Malaysia is home to a lot of manufacturing and service provider companies, where it's very interesting to see point two, where low risks entities, where it's a very difficult position to actually substantiate the losses. When we were doing a risk analysis, high risk, high return, low risk, low return, right? So on a risk basis, we would imagine entrepreneurs will be bearing more risk, which means more losses, as compared to the low risk entities. It says low risks, doesn't mean no risks. So which means low risks entities will still have certain risks involved in their business operations, right? When we perform a risk analysis on those manufacturing or service providers, we look at which risks are actually impacted by the COVID-19, um, and then properly allocate those losses accordingly. So low risk entities does not mean they will not bear any losses. It's just the amount of losses that they are bearing. So as compared to entrepreneurs. So it's interesting to see how the Malaysian tax authorities or the OECD we're looking at substantiating low risk or the allocation of risks and losses between the entrepreneurs and the low risk entities, where we understand tax authorities around the world would want to ensure that the losses are kept minimal, so that next year the profit will come back, and then entrepreneurs will start getting more profit than low risk. So this is where it happens when tax authorities, when there's a proper profitability involved, then they would want more income, and then now there are more losses, they want less losses. So it's interesting to see how tax authorities around the world will argue on this case.
That's a great point you bring, because I think our job as the advisors, if you have low risk entities, and I fully agree with you, is to explain to the tax authority that low risk doesn't mean no risk. And I think that's going to be the biggest challenge, especially in Southeast Asia. Places like Vietnam, Thailand, Indonesia, Malaysia, very focused on guaranteed profits. So I think that's a great point, HC. Thank you for that. So let's move on with strategy 4 and 5. With strategy 4, I think the purpose of this strategy is to explain to all the audience that what is the impact of changes in the supply chain due to COVID-19 in your transfer pricing. So changes in the supply chain can result into new related party transactions, new prices for all related party transactions, new markets and countries. This is a big one. Manufacturing, we have seen a lot of news lately about manufacturing entities and manufacturing companies exiting China and moving to other countries like Vietnam, Thailand, and Malaysia. New business models. I think all of the above points, what it means is that if you have any of these situations or any of these points arising from changes in the supply chain, the first thing is you may have to rethink or re-amend your TP strategy. And by that means, okay, redefine again who are the entrepreneurs, who are the routine entities, or who are contributing in the IP of the company. Rethink the strategy in terms of what will be the new prices, how they will look like. And 3, I think if any of the above happen, you will have to prepare documentation to support your case, because all documentation with your all supply chain will not be sufficient. That is a key point here. Any of these points will probably result in having to refresh your documentation and your TP policies. And I will close the day today with strategy 5. Strategy 5 is basically talking and coming to a very practical issue that we have been asked lately. What do I do if a related party entity cannot pay interest rates? So I think a couple of things, and when a related party cannot pay an interest rate or cannot cover the interest expenses, the first thing that will happen in any third party situation is a renegotiation of the terms of the loan. And what that renegotiation means could be 2 or 3 things. One is, first, if a related party cannot pay the interest rate, the first thing is whether there is industry and commercial reasons that support the fact that the company cannot, or the borrower cannot satisfy or cover interest expenses. So coming back to strategy number 1, an explanation on the effect of COVID-19 and how profit and cash flows have been impacted. And then you can consider option 1, which is, okay, can I delay interest payments on a temporary basis? And I think if third-party banks in the particular country, say Australia or Singapore or Malaysia, are suspending interest payments for a certain period of time, say 3 months or 2 months or 4 months, that would be a very good argument to explain that if a third-party bank is allowing the delay on interest payments, it makes sense to allow the concession for related party loans, because it's happening in a third-party scenario, and that would be a very strong case, together with showing the impact on cash flows. The second issue will be whether there is basis to recharacterize short-term loans into long-term loans and potentially renegotiate the interest rates. Any renegotiation will need to be documented and added into the existing loan contract to make sure that we don't have any issues with the country where the lender or the borrower are located. And I think with that, we are coming into the end of our webinar.
We just got one more question here, actually, Adriana. So how will companies and tax authorities manage the APAs that are already in place? And will tax authorities allow changes to be made on the APA? So I know you talked about agreements, meaning, you know, between the related parties, but what about in the situation with APAs?
Okay, that's a great question, and I'm happy to get ideas from my colleagues Shannon and Honcho and Tan. But my first thinking is, when you negotiate an advance, for those who don't know what an APA is, it's an advance pricing agreement with the tax authority. And when there is a negotiation of an APA, there is something called critical assumptions. So those critical assumptions, if I'm not mistaken, sometimes take into consideration that there is not an economic event like this one, like Black Swan. If your critical assumptions change, there is basis to go back and ask to a tax authority to reconsider the price agreement. So I will say, if you have an APA in place, check your critical assumptions that were used for the purpose of the APA, and consider whether there is basis to renegotiate with the tax authority. Shannon and Honchon, any other?
That approach would also be consistent. That approach would be consistent in Australia.
Yeah, for Malaysia, that's exactly correct. So when APA are being negotiated, it would be more in line to the markup or the arrangement during a normal ordinary course of business. So with COVID-19 is in place, then that would deviate from your ordinary course of business. And as Adriana has mentioned, we need to look at the critical assumptions and I wouldn't say renegotiate, but relook at the terms, and you liaise with your respective tax authorities to understand what their approach is with the APA itself, because APA takes a long time to be negotiated and put in place, right? So the existing APA would be there for ordinary course of business. We just need to liaise with the tax authorities to negotiate on the critical assumptions as to what's happening after this COVID-19, and then we'll go from there. Thanks.
Excellent. Shannon, are there any other questions?
No, that's all the questions that we have coming through. So that's good.
Okay, then let's just finalize our webinar just by very quickly going through our leadership team and the team that have spoken today. So as we spoke earlier, Shannon Smith, who is the director and the technical lead in Australia. Shannon Smith is the founding director of Transfer Pricing Solutions with more than 25 years of experience in transfer pricing advisory. she's also and correct me if I'm saying this incorrectly, so Shannon, her, because I know this is like super important, and I always talk about this, which is Australia. She has been appointed to the Australian Government Board of Tax Advisory Panel since 2016.
Yes.
Myself, which is Adriana Calderon, technical lead in Singapore, co-founder of Transfer Pricing Solutions Asia and Malaysia. Apart from having more than 15 years of experience as a transfer pricing practitioner, I also passionate about teaching. I teach in the Institute of Chartered Accountancy in Singapore Institute of Accredited Tax Professionals, and I'm currently an associate lecturer for Singapore Institute of Technology. And Hon Chuan Tan, who is the director and technical lead and genius in Malaysia. He has more than 7 years of experience in transfer pricing and GST. He has played key roles in and pioneer in developing some of the transfer pricing practices of Transfer Pricing Solutions Malaysia, and also some of the mid-tier firms in Malaysia. He also has experience in preparing master file, local file, and advising companies in the Asia Pacific region. If you ever are interested in looking into some technical content, we have some industry articles and that have been published on our workshops in the Institute of Singapore Chartered Accountants, a journal called ISCA Journal. So feel free to browse and look. We have the links here. And I think that's it from us today.
Yeah.
Yeah.
No more questions come through, so that's great.
Thank you very much, everyone. The address, our contact emails, our websites are also here. Follow us on LinkedIn, Facebook, Twitter, or just drop us an email in our email addresses.
Okay, well, thanks very much, Adriana.
Thanks, everyone, for attending.